Hello everyone. In this video I'm going to cover chapter 5, which basically discusses the relation between cost of production, volume of production and sales, and profit resulting from operating activities. By the end of this chapter, we will be able to answer questions such as what happens to my net operating income if a competitor enters the market and my sales drop down by, for example, 20%, or if I pay an additional $10,000 in my total fixed expenses as marketing expenses, and this is expected to increase my sales by let's say 30%. So should I go for this or not? What impact does it have on my net operating income? Also, I'd be able to answer questions such as, should I decrease my price by $2, given that this will increase my quantity, expected to increase my quantity sold by 15%, and so on and so forth. Several questions can be asked and answered in the CVP or cost volume profit relationship. Before I start the chapter, I'd like to remind you that the income statement has two formats, the traditional format and the contribution margin or contribution format. In the traditional format, you know that, so this is the traditional format income statement, you know that we start with revenues minus cost of goods sold, you get gross profit, then you deduct other expenses, and eventually you end up with net operating income. In the contribution format income statement, you start with revenues and then you deduct total variable cost. And this total variable cost is partially comprised of cost of goods sold and partially from other expenses. When you deduct total variable cost from revenues, you will get the contribution margin. Then finally, we deduct total fixed cost to end up with the same net operating income, which is identical to the traditional format net operating income. This value over here is called contribution margin because it contributes to covering the total fixed expenses or fixed costs. Okay, so now we're going to explain how changes in activity affect contribution margin and net operating income. So assume that we have a company called Racing Bicycle Company. So obviously they sell racing bicycles. Their current level of activity or of sales is 500 bicycles, for which they are sold for $250,000. So each bike is being sold for $500. The variable expenses are $150,000. So each bike has a variable expense of $300. I'm simply dividing the total by the number of bikes. This yields a contribution margin of $100,000 for all of them. So the contribution margin per one unit, which we call CM unit, is equal to the $100,000 divided by the number of bikes, which is 500U or units. You know that I use this U thing to indicate the number of units, and this is equal to $200 contribution margin per one bike being sold, less fixed expenses. This will get us a $20,000 in net operating income. Okay. Now, let's move. So, okay, here they're introducing the concept of CM. I already introduced that. And and CM per unit, as you can see here, is $200, and we also introduced that. They are okay, so fixed expenses. This is done. Okay, now if the number of sales goes down to 400 bikes, as you can see, the net operating income becomes zero, and this is the break-even point. From microeconomics, the break-even point is when your profit is equal to zero, and in economics they use this pi for profit, right? Okay, so you need to sell 400 bicycles in order to attain a profit of zero, which is the break-even point. What about if you sell 401 bikes? Your net operating income will become $200, and this number is what? This is the CM unit, or unit CM, doesn't matter. So this means that for each additional bike you sell, your net operating income will increase by unit CM. So for each additional bike you sell, net operating income will increase by unit CM, or CM unit. Okay, this is important for further analysis. So for example, if they ask us that the company will sell an additional 30 units above the break-even point. So as you remember, the break-even point was 400 units, at which you get a profit of zero. Now at 430, it means that your net income, or net operating income, will increase by 30 multiplied by CM unit, which is basically 30 multiplied by $200, and this is equal to $6,000. I know that at 400 my net operating income is zero, therefore at 430 it will become 6,000. You can do this in this approach, which is a shortcut, or we call it differential analysis, or you can do it using the traditional income statement. So you plug in 430 on sales, 430 for total variable cost, you deduct total fixed cost of 80,000, and you get in net operating income 6,000. So the relationship between profit, sales, variable expenses, and fixed expenses is as follows. This is net operating income, which is equal to revenues minus total variable cost minus fixed cost, or total fixed cost. These two here, when you deduct them from each other, you will get the contribution margin. So in other words, net operating income is equal to CM minus total fixed cost, right? Great. And if you break this figure here further down, you can get the number of units multiplied by unit CM, or CM unit, minus total fixed cost. So now, if, for example, if I ask you what is the needed number of units to be sold in order to break even, so it means that when I say in order to break even, it means that net operating income is equal to zero. So you can simply place this one with a zero and say that Q multiplied by unit CM minus total fixed cost should be equal to zero. Therefore, my number of units that needs to be sold in order to attain a profit of zero is equal to total fixed cost divided by unit CM. right? So I'm simply rearranging the equation. Okay, we will get back to this in. So here they are simply plugging in numbers and telling us that when you sell 401 units, you will get a profit or a net operating income of $200. Remember that profit is the same as net operating income and the same as the pie in microeconomics. Okay, so here basically they are simply restating what I said a moment ago, that net operating income is equal to Q into P minus V minus total fixed expenses or costs, and this is basically the price minus variable cost per unit is equal to the CM unit or unit CM. Okay. This is with some numbers. So they reached uh, the equation that I stated a couple of slides ago, which says that net operating income is a function of quantity multiplied by unit CM minus fixed expenses or fixed cost, total fixed cost. This is, I think it's easy, right? I suppose it's easy. The funny thing is that I'm asking if it's right. Okay, so now we're gonna use the contribution margin ratio, and we will learn what is a contribution margin ratio to compute the changes in contribution margin and net operating income resulting from changes in sales volume. So if the number of quantities, if the quantity being sold changes, what happens to my contribution margin and my net operating? So the first thing I want to introduce is that the CM ratio is basically the contribution margin divided by sales. So if you have uh, revenues minus total variable cost, this will give us CM. You deduct total fixed cost and you get into net operating income. This is the contribution format income statement. If you are selling uh, at $100 and your total variable cost is 60, therefore you are left with $40 for your CM, and therefore your CM ratio is basically 40 divided by 100. This is the CM ratio, and this is a 40%. So a 40% means that if you sell by additional $1, your net operating income will increase by 40 cents. So if my CM ratio is equal to 40%, then for each additional $1 in sales, my net operating income will increase by how much? 40% multiplied by $1, which is basically 40 cents. Okay? This is the importance of knowing the CM ratio. I want to introduce one more thing here before I move on to the next slide, and it's the variable cost ratio. So if the CM ratio is the contribution margin divided by sales, then the variable cost ratio is the total variable cost divided by sales. And in my example over here, the variable cost ratio is 60 divided by 100. So this is equal to $60 divided by $100, and this is 60%. So what can we conclude from that? This means basically that the VC ratio, or the variable cost ratio, plus the CM ratio is equal to 100%, or in other words, it's equal to 1. Okay, so basically this one is divided into two parts, the cost and the profit. The CM is the profit, the additional profit, and the cost is the total variable cost. Okay, so this is basically stating everything so far. What is the variable expense or variable cost ratio? So in my example, I said VC, variable cost. This is saying variable expense. It doesn't matter that much, it's the same. So 60% plus the 40 for the CM ratio gives us 100%. Yeah, so this is exactly what I said, that the sum of them is equal to 1. Okay, so now if the company, if RBC increases sales from 400 to 500 bikes, my net operating income will increase by a CM unit multiplied by 100 units. These 100 units are the increase from 400 to 500. So my CM unit, I know that it's $200 multiplied by the 100 units. This will give me an increase in my net operating income by $20,000. Okay, now a numerical example says that coffee clutch and espresso stand in the downtown office building. The average selling price of a cup of coffee is $1.49, almost 1.5. And the average variable expense per cup is 36 cents. The average fixed expense per month is $1,300. An average of 2,100 cups are sold each month. What is the CM ratio for coffee clutch? So in order to get the CM ratio, we need CM and we need sales. We know that sales are equal to 1.49, which is the selling price per 1 cup multiplied by 2,100 cups. And I know that my total variable cost is equal to $0.36 multiplied by the same number of cups. From that, I can get my CM, which is equal to sales minus total variable cost. Now, sales is equal to 2,100 multiplied by 1.49, and this is equal to 3,129 dollars. As for total variable cost, is equal to 756, and therefore my contribution margin is equal to $2,373. So the CM ratio is equal to 2,373 divided by 3,129, and that's equal to 75.8. So the answer here is B, and this is my CM ratio. So for each additional dollar I sell, my net operating income will increase by 75.8 cents. Okay. So this is the number that we calculated, and I showed you how to calculate that. Okay, so here basically they are rearranging the whole thing. If you insert here, instead of CM ratio, CM divided by sales. Okay, and continue, multiplied by sales minus total fixed cost. What will you get? You will have sales offsetting this sales, and you will end up with something saying that it's CM minus total fixed cost, which is basically profit. Okay, we are using this to make our life easier in order to answer questions such as how much do you need to make in sales so that you attain a specific number in profit. You'll see what I mean. So show the effects of net operating income on changes in variable cost, fixed cost, selling price, and so in this example, we're being asked what is the profit impact if RBC can increase unit sales from 500 to 540 bikes. We can solve this in a couple of methods. We know that at Q equals to 500 units, my net operating income is equal to $20,000, and I know this from prior stats. So therefore, at Q equals to 540 units, my net operating income will be 20,000 plus the 40 units additional 40 units, the difference between this and that, multiplied by the unit CM, which is 200. So apparently this will be 20,000 plus $8,000, right? So 28,000. However, here they are telling us that you need to pay $10,000 for a marketing campaign or the advertising budget, and therefore we need to deduct $10,000 as a total fixed cost, and therefore you will be left with $18,000. Thus, it's a bad idea to invest $10,000 in this advertising thingy in order to increase the number of units sold from 500 to 540. And this is what we just established, that you are losing basically $2,000 by increasing unit sales from 500 to 540 at an additional $10,000 in marketing cost, right? So it was 80, it has become 90 due to the marketing campaign or a shortcut solution to this problem can be basically by asking yourself what is the difference or the incremental or the differential analysis. So incremental or differential analysis says that your net operating income will increase by $8,000, and this is basically the 40 units multiplied by the unit CM, and it will decline by $10,000, which is the additional advertising expense. Therefore, in total, you will be making a loss of $2,000. In another example, they ask us what is the profit impact if RBC can use higher quality raw material, thus increasing variable cost per unit by $10, so it becomes 310 instead of 300, to generate an increase in unit sales from 500 to 580. Again, here you can do the full approach where you can prepare a new income statement or do the differential analysis. In the exam, you have the option to do either as long as you get. Here they show us the full approach where your uh, the quantity increased by 80 and therefore the revenue increased from 250 to 290,000. Of course, the total variable cost will increase as the number of units increased and the variable cost per one unit increased by $10. Eventually, you will have an increase in net operating income by $10,200. So this is a favorable decision. Example 3 says, what is the profit impact if RBC cuts its selling price by $20 per unit, increase advertising budget by $15,000, and increases sales from 500 to 650 units per month? So now you'll have to prepare a new income statement where you have on the revenue line 650 units multiplied by the selling price, total variable cost, the selling price minus 20, because here they told us that they decreased the selling price by $20. Your total variable cost will be 650 units multiplied by $300. And you do the rest the same. You get your new CM minus total fixed cost, which was the 80,000 plus an additional 15, right? Due to this advertising budget. So your new income statement should look like that, as follows. This 312,000 is the 650 multiplied by 480. 480 comes from the old 500 minus the discount in the price of $20. And your fixed expenses increased by $15,000 due to the advertising budget. Your net operating income due to that increased by $2,000. And again, this is a favorable outcome. What is the profit impact if RBC pays a $15 sales commissions per bike sold instead of paying salespersons flat salaries that currently total $6,000 per month? And concurrently, the unit sales increases from 500 to 575 bikes or units. Here you need to understand that this increase by $15 commission is an increase in total variable costs, because sales commission varies with number of units sold. The $6,000 per month is an increase in total fixed cost. Sorry, it's a decrease. So instead of paying salesperson flat salaries, so there's a decline in total fixed cost by 6,000. So now in the new income statement, the total fixed cost will decrease by 6,000. So this is the minus 6K. And your variable expense will increase by $15 per each additional bike sold. And therefore, as an outcome, your net operating income will increase by $12,375. Example 5 asks if RBC has the opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses. What price would it quote to the wholesaler if it wants to increase monthly profits by $3,000? So here we are only selling 150 bikes, and the total fixed cost for this transaction is zero, because the existing 80,000 in total fixed cost will be paid no matter what. So whether you sell these additional 150 or not, it will be paid the 80,000. So for this transaction specifically, the total fixed cost is zero, so we don't have total fixed cost. We want a profit of additional profit, $3,000 from these 150 bikes. So the profit from each bike is equal to the $3,000 divided by 150 units, right? And this will get us $20. Okay, so each bike must make a profit of $20 so that I can make a total profit from this transaction of $3,000. I know that the variable cost per one bike is equal to $300, right? So at what price should I sell so that I make a total profit of 3,000? Obviously, the price must be $320 per one bike. And this is the solution, $320 per one bike, so that I can get $3,000 in my net operating income from this specific transaction. Now, determine a break-even point. Before we determine a break-even point, I need to introduce a couple of concepts. We agreed that profit is equal to sales minus total variable cost minus total fixed cost. Then we were able to have Q multiplied by P for sales, so quantity multiplied by price, minus Q multiplied by V for total variable cost and total fixed cost. Then we took Q as a common factor, so it became P minus V minus total fixed cost, and we already established that P minus V is the unit CM, so Q multiplied by unit CM minus total fixed cost. And this is always profit. Now, if I ask you what is the required number of units that need to be sold so that you can get a profit of 0, all you need to do is to replace this profit with a 0 and solve for Q. So this means that Q multiplied by unit CM minus total fixed cost is equal to 0, and therefore Q is equal to total fixed cost divided by unit CM, simply rearranging the whole thing. So this is the number of units that needs to be sold so that I can get a profit of a 0. Now, what if I ask you, one second. What if I ask you, what is the required dollar sales in order to get a break even or a profit of a 0? So the starting point is the same. The starting point is sales minus total variable cost minus total fixed cost. Now, instead of can we replace this thing here by simply saying that it's CM minus total fixed cost? It is the case. Sales minus total variable cost is contribution margin. Okay, and we also know that the contribution margin is equal to CM ratio multiplied by sales minus total variable cost, total fixed cost. Because if you think about it, this thing over here is basically, the CM ratio is CM over sales multiplied by sales. So this goes away with this one. So you are left with CM minus total fixed cost, which is this this figure. So we reach this the point where we are saying that profit is equal to CM ratio multiplied by sales minus total fixed cost. So if I ask you what is the required dollar sales amount in order to attain a break-even or a profit of 0, so replace this with a 0 and solve for sales. So it's the CM ratio multiplied by sales minus total fixed cost, and therefore sales to break even is equal to total fixed cost divided by CM ratio. Okay, so this is how you can determine a break-even point in terms of quantity and in terms of sales. If you want to get into sales, you need to have the equation that has CM ratio inside it. If you want to get into quantity, you need to have the equation where you have CM unit inside it, and I'll show you in a minute what I okay, so this is basically, there is no need to stress this point. Okay, now the equation method relies on the basic profit equation introduced earlier in the chapter. Because racing bicycle or RBC has only one product, we'll use the contribution margin form of this equation to perform the break-even calculation. Okay, we calculate the break-even by solving the equation below. Profit is equal to unit CM multiplied by Q minus fixed expenses. Here we are solving for Q. You can use the contemporaneous or analogous equation to get into sales. So you can say that profit is equal to CM ratio multiplied by sales minus fixed expenses. And now simply rearrange to get into sales. Sales is equal to total fixed cost divided by CM ratio. And this is how you get the dollar sales to break even. So mind something, when you want to get quantity, in order to break even, you will be using the equation that has unit CM. When you want to get sales in dollars, you will use the equation that has CM ratio. So to get Q, use the equation with unit CM. To get dollar sales, use the equation with CM ratio. Okay? Okay, so here they computed the number of units required to get a break even or a profit of 0. I'm skipping because I covered all of these before. Now, this is the case where you want to solve for sales. So profit is equal to CM ratio multiplied by sales. Just to remind you that CM ratio is equal to CM divided by sales multiplied by sales minus fixed cost. So basically you are saying that profit is equal to CM minus fixed cost, which is the case because CM in turn is equal to sales minus total variable cost, right? Deduct total fixed cost and you will get back to a profit. So to solve for sales to attain zero profit or break even, you will simply say that sales to break even is equal to CM ratio, total fixed cost divided by CM ratio. And we got this thing from here. So this is the equation. Dollar sales to break even is fixed expenses divided by CM ratio, and you can say that quantity to break even is equal to fixed expenses or total fixed cost divided by unit CM. So again, I'm trying to stress this as much as possible and whenever relevant. That if you want to get quantity, you will use the formula with unit CM. If you want to get dollar sales to break even, you will use the formula with CM ratio. And the numerator is always total fixed cost or expenses. Now, coffee clutch is an espresso stand, so the same given. The selling price for um, a cup of coffee is $1.49. The variable cost per one cup of coffee is 36 cents or $0.36. The average fixed expense per month is $1,300. An average of 2,100 cups are sold each month. What is the break-even sales dollars? So I know that. So if you want to derive it, if you don't know it, you know that profit is equal to sales minus total variable cost minus total fixed cost, and this is always the starting point. And this is equal to CM minus total fixed cost. If you want sales inside this, you'll get CM over sales multiplied by sales, where basically we multiplied by 1. Sales over sales is 1. And this is equal to CM ratio multiplied by sales minus total fixed cost. So rearrange this to get a profit of 0. They are asking for break even. So sales to break even is equal to total fixed cost divided by CM ratio. The total fixed cost, I know it's given, and it's given at, one second, it's given at $1,300. So sales to break even is equal to $1,300 divided by CM ratio. CM ratio is equal to CM over sales, right? CM itself is equal to quantity into P minus V. So Q multiplied by P is sales, and Q by V is total variable cost divided by Q multiplied by P. So you can get rid of these two, and therefore you can calculate your CM ratio as P minus V over P. Or basically what you make in profit from selling 1 unit divided by the selling price. So in the numerator for the CM ratio, you can have P minus V, which is the 1.49 multiplied by the V, which is 0.36, divided by, of course, these are together, divided by 1.49. You do the math, and you get this number. So you need to sell $1,715 per month in order to get a profit of 0. If you remember, this number here was computed previously in the example of coffee clutch, but we computed it again this time. Okay, the same given. Now they are asking what is the break-even sales in units. So again, to get profit, but this time in terms of quantity, so you can do this CM unit or unit CM multiplied by Q minus total fixed cost. So now quantity is equal to total fixed cost divided by CM unit or unit CM, and therefore you will be having $1,300 divided by the unit CM is equal to 1.49 minus 0.36, and you do the math to get the number. So you will have to sell 1,150 cups in order to get a profit of 0. Now determine the level of sales needed to achieve a desired target profit. So far, we learned that if we want to get sales to break even and quantity to break even. In the sales case, in the sales to break even, we established that sales to break even is equal to total fixed cost divided by CM ratio. This equation came from profit is equal to CM ratio multiplied by sales minus total fixed cost. And when we were solving for sales, for this number over here, we had this as a zero, the profit as a zero. So this is to break even. Now, if we want a target profit, assume that we want a $1,000 in profit, not a zero. So we do the same. This is CM ratio multiplied by sales minus total fixed cost. Now solve for sales. Sales is equal to total fixed cost plus the $1,000 targeted profit divided by CM ratio. So we've done the same, but instead of having a zero plus total fixed cost, which is the break even, now we have a $1,000. The same applies for Q. Q to break even is, so VE, Q to break even is equal to total fixed cost divided by unit CM. Now, Q to get to make $1,000 profit is equal to total fixed cost plus the $1,000 divided by unit CM. Okay, so the same concept. So again, okay, here they distinguish between the equation method and the formula method. They are exactly the same, they lead to the same answer, and I wouldn't even distinguish between them. Now, our goal is to solve for Q, and we know that when you have a break even, Q to break even, you place profit as a zero. Now you have a target profit, so instead of a zero, you will have a number. It's still an equation with one unknown, and it's very simple. So here they are telling us that we need to attain a profit of $100,000. What is the required quantity to be sold to get that? It's 900 units. Here we're talking about RBC. We're not talking about the coffee clutch example anymore. So 900 units in order to attain a profit of 100. Quantity, in terms of quantity, so again, I told you that Q is equal to make a certain profit, or for target profit, it's equal to total fixed cost plus, let me call it the target profit, which is the $100,000 in our example, the preceding one, over CM unit, or unit CM. Okay, if I want this as sales, not as Q, so sales required to attain a profit, instead of having CM unit, you will have the CM ratio. Okay, we already covered that. We can also use this for the sales dollars. We already introduced this. They are slow. We are faster than them. And this is how to get sales required to get a certain amount of profit. So you need to sell $450,000 to make a profit of $100,000. If you think about it, you can get the number, the quantity needed to attain the same profit from this number here. So $450,000 divided by the price is equal to 450 divided by the $500, and this is the 900 units required to get the same profit. I'm just trying to make a link for you. These are the equations that established. Now the question is, use the formula method to determine how many cups of coffee would you have to sell to attain a profit of $2,500. So I know that here they are asking for the number of cups. So for Q is equal to total fixed cost plus the target profit divided by the unit CM. Total fixed cost is known for $1,300 plus the target profit is given at $2,500 divided by unit CM is 1.49 minus 0.36, which is P minus V, right? And you can do the math to get the number as a required number of cups, which is 3,363 cups to attain a profit of $2,500. The same question, but this time they are asking in terms of sales dollars. You can play it smart and multiply Q by P, the Q to get a profit of $2,500, which was computed in the previous slide, which is 3,363 units multiplied by $1.49. But assume you will get the right answer. Assuming that you don't know this, you don't know Q, you will have to get sales to attain a target profit of $2,500 in a sense that it's equal to total fixed cost plus $2,500 divided by the CM ratio, and the CM ratio is equal to 0.756, which was computed multiple times or a couple of times so far. Do the math and get the number. This will get you a number of $5,013 in sales in order to make a profit of $2,500. Okay, margin of safety. Margin of safety is basically anything above the break-even quantity or sales. So if your Q to break even is equal to, let's say, 400 units, and currently you are selling 460 units, these 60 are the margin of safety. The same applies for dollar amount. So this is a very simple. So margin of safety in dollars, and this can be instead of dollars quantity, total sales minus break-even sales, or total quantity minus break-even quantity. So here the margin of safety is this $50,000, as simple as that. What else? In terms of units, I explained that. So the same given for the coffee clutch. What is the margin of safety expressed in cups? We know that we can compute the sales to break even, okay, and then we know what is our current sales. The margin of safety is the difference between those two. If you divide them by the selling price, you will get the Q as a margin of safety. So margin of safety is total sales minus break-even sales they translated them into cups. So currently we are selling 2,100 cups. This is given. We computed the break-even sales in terms of cups, and therefore your margin of safety is 950 cups. The last learning objective is the degree of operating leverage. Leverage is the simple meaning of leverage, anything that lifts your profit. The degree of operating leverage is equal to the CM divided by your net operating income. And this is usually a multiplier. So, for example, if your CM is 5 times your net operating income, it means that if you increase your sales by 10%, your net operating income will increase by this 10% multiplied by the degree of operating leverage. Okay, so again, degree of operating leverage is equal to CM over net operating income. This is a multiplier. Let's say it's 4. It means that if sales increase by 10%, my net operating income will increase by 4 multiplied by the 10%, which is 40%. Okay. So for example, actual sales increased in sales from 500 to 550. We have an increase by 10%. So my sales increased by 10%, and I can compute my degree of operating leverage as CM over net operating income, which is, this is the CM and this is the net operating income. So obviously it's 100,000 divided by 20,000. So I would expect my net operating income to increase by 5 multiplied by the 10% increase in sales. So the old net operating income is equal to 20,000. The new net operating income is the old multiplied by 1.5, which is an increase by 50%. Right? So it's a $30,000, the new operating income. Example, what is the degree of operating leverage for the coffee clutch example? The degree of operating leverage is equal to CM over net operating income. We need to compute the CM. The CM is simply 1.49 minus 0.36 multiplied by quantity, which is the 2,100 units, divided by the net operating income, which we need to compute. And you can do the computation, get 2.21, which means that if so here they computed the net operating income for you and plugged it in the equation so that you can get the degree of operating leverage. So now it means that if my sales increase by 10%, my net operating income will increase by 22.1% if my sales increase by 20%. Such a question, exactly. So if your sales increase by 20%, by how much should your operating income increase by? It's 20% multiplied by DOL, degree of operating leverage, which is 20% multiplied by 2.21, and obviously it's this number, the 44.2. So here they are showing us the actual and the increased sales and how this is reflected as a function of degree of operating leverage. And this is the end of chapter 5 I'll see you with a new chapter.